Tim's going to share with you some of his visions for our future, right?
Yeah, exactly.
So anyway, give Tim Smith a hand.
Thank you.
So I had this really refined presentation that I was working on this morning
Did you hear that story?
with a little bit of a headache on my iPad. And I did it in an email form, and then I forgot to send it to myself and left my iPad at home. So I have a little bit of a draft here, but I think I got it down here. So this is a fun segment to do because I get to talk about all the exciting growth plans we have. And we're a company, as you know, that we've experienced really good growth consistently since our inception. And we're now embarking on a time where I think we're going to be growing more exponentially because we're opening up new growth channels. And the three areas of our growth are the continued evolution of our opportunity fund and the assets that go into that. We'll talk about that. And then we've got two new acquisition channels that we're pursuing and serious about and getting going on. And then we've got the development channel that we are, is Graydon here? Graydon heads that for us, and I kept calling it our fledgling development channel. He didn't like that because he was envisioning like a baby bird with bird legs kind of wobbling. Oh, there he is. And now it's actually evolved to be in the budding category. We're now budding in our development channel. So let's talk about those three areas. So as you know, we're in the middle, or we're nearing the end of allocating or buying assets into opportunity. We call it HRA Opportunity Fund 2. And we have, it's a $110 million equity fund. And then we marry that with we've been leveraging the properties about 65%. So we take that capital, we marry it with about 65% more in debt. And so if you take 110 divided by 35, yeah, 330 million in assets. So on that fund, we have 4 assets in it. Rob and the team, the acquisitions team, have another asset called Stonehill Apartments in North Austin. We really like Austin. I'll talk about our target market strategy in a minute, but that's one of them. And that's a brand new lease up. We're just waiting for it to get 90% occupied, which is almost there, and we're going to close it in a couple weeks. And that will bring us to about 80% allocated. Emily's here. Hi, Emily.
Emily's here.
She's got the new mom glow. Yeah. So then we'll have room for one more asset, and the acquisitions team is in hard pursuit of a number of different opportunities. So I think that will likely happen in second quarter of this year, and that'll round out Opportunity Fund 2. And we need to get working on our documents because we want to come out with the next evolution of what we're calling the HRA Opportunity Fund, and we'll come out with HRA Opportunity Fund 3. I spent a lot of time working on that name, and it just kind of came to me. So we're evolving. Our first fund was 80 million. This last one, 2, is 110 million. It's logical that with the success of those funds, we'll have enough demand to do something like a $140 million fund, which, Scotty, would give us how many in assets?
420.
About 420 million, yeah. So if you think about that, so that'll be second quarter of this year. We'll get that offering out, and then we'll go buy the assets into that over the next 2 years. And so that'll look like 2,000 to 2,500 units. And we haven't fully defined what the fund's going to be, but it'll be kind of like Opportunity Fund 2, and we're going to target mostly value add or what's called core plus type opportunities. And I'll define what that is, because you'll hear these terms: core, what's a core asset, what's core plus mean, value add, and there's actually another category which is opportunistic, which our name would kind of imply that we're doing all opportunistic, but we're really doing more things like value add or core plus. And so a core asset is, think a brand new high rise in downtown Seattle.
Right there behind you.
Is it brand new?
Well, Bellevue.
Oh, in Bellevue,
Yeah.
or Bellevue. So a major market, brand new building. It's also characterized by how much the buyer how much debt they'll put on it. And so usually it's like 40-45% debt. These are assets that are considered like a bond, kind of. They're income assets, low risk assets. And so with that, you get lower returns. So that's core, and that's a world we haven't been in yet, but we're endeavoring to get into it. And I'll talk about that in a second, our new channel. So that's core. Core plus is a little more risky. You're biting off a little more risk. It's a slightly older asset, doesn't have to be in a major market. You can use more leverage when you're buying it, and you probably do. So we have a lot of our assets you could characterize as core plus. So think the Landings, or think Highlander, Venue North Campus. We're talking assets that are 5 to 10 to 15 years old. There might be a light lift in terms of the renovation work. Maybe you're going to update the clubhouse and reprogram it a little bit. Like we do, we'll bring in or redo the fitness center so it's state of the art. Those would be core plus type of renovations, and maybe even some unit renovations. And then there might be some management improvements. So you're going to improve it through your operations. We're looking at buildings that don't have, the owners are not utilizing revenue management software. So that would be an example of, we're going to come in and we're going to do that. We're going to manage it better, and that's part of what we're going to do. So that's core plus, and then you get into value add, and now we're talking about we're moving along the risk spectrum. Core is over here, low risk, closer to a bond, like a treasury, but a little higher return than that. Core plus, this might be 7 to 10% yields on a core asset. Core plus, maybe it's 9 to 12% annual yields. Now you get into value add, we're going to reprogram it. We're going to do a heavier renovation. Think the Phoenix, Sacramento. Phoenix, Sacramento, we came in and it was really in rough shape. The seller was running it like a slum. We came in and did a very heavy renovation, and we're continuing some of those, but it was more than $10 million. We reprogrammed it from a pure conventional to a hybrid, where we were catering to students and conventional renters, and totally revamped the operation. So that's a value add, and if you can do it successfully, and our timing was good too, you get huge returns. And so that one worked out like that way. The Phoenix and Reno is another example, a little smaller asset, but very similar. So you're taking on more, it's riskier, higher degree of difficulty with the execution, but if you're successful, you're going to get higher returns. Student housing, these aren't hard and fast. We have things that you could kind of call value add, or is that core plus, and there's a lot of different factors that come into it. What kind of market is it? Student housing in itself is hardly core just because it's so intensive to manage. So a core asset in the student world might be a public-private partnership where you've got kind of guaranteed, you know, the school can control the students going into the building is brand new. So that's probably, any questions on those terms? It comes into play into the different channels we want to get into. Historically, we've made our bread and butter in the value add and core plus world and really applying our expertise. Yeah.
Can you speak to opportunistic? I stepped up from that.
Opportunistic is really, it's like ground up development would be considered opportunistic. Going in and buying an office building and converting it to apartments. You could argue that what we did at Phoenix, Sacramento was more toward the opportunistic end of the spectrum because we reprogrammed it on top of an old asset, on top of a heavy renovation. So that's channel number one. It's our HRE Opportunity Fund. We're going to be doing mostly core plus and value add type acquisitions for that. 2,000 to 2,500 units over the next couple of years, starting third quarter of this year. And yeah.
Category is Stonehill, then how would you put that asset?
It's a new asset that's not a core. It would be core plus. I mean, really to get core, it's tier 1 city, CBD, high-risey, low vacancy market. Okay, so
On that.
Let's talk a little bit about our target market strategy. So, as Greg said in the introduction there, we have been a little bit sporadic in our approach of where we would go and the assets we would buy. We kind of went, and student housing drives you to this to some degree. You kind of got to go where the opportunity is. And we're evolving to where we're going, there's probably a better approach. And if you look at the time we've spent pursuing potential acquisitions and then they don't get through our approval process, through the committee after due diligence, it's usually because of concerns about the market. It's not, normally we can kind of get our heads around the asset itself. And so when we don't approve a deal, it's because we've dug into the market and determined we don't like the market or the way this deal is fitting within that market. And so we realize that, it's a much better approach to identify the markets we want to be in, really vet that out, get everybody on board with that, and then go buy properties in those markets. And so that's what we're doing, and it's a target market strategy. Currently, we have identified Phoenix as a target market, Austin as a target market, Seattle as a target market, and then we have other markets too, and we kind of rank which ones are we're most excited about. And we do that after, and we're getting better at it, we do it after in-depth study of a bunch of dynamics. What's happening with the demographic trends? What's the jobs picture? I pulled one up here. I'll just talk about Seattle briefly. So we're trying to take all of this data and bring it down to an elevator pitch as to why we like that market. And the bullet points on the Seattle market are, we have a very diversified and high-tech job growth engine here with all the high-tech companies that are just, Amazon currently has 11,000 open positions in Seattle. They've telegraphed that they're going to hire 15,000 people across the pond. And then you have Apple, Google, Oracle, the list goes on, Microsoft. So it's kind of incredible, and it's also evident, and one of the harbingers that we're looking at for this demand is what's happening in the office market. And what you see happening in Seattle is there's 6.9 million square feet of construction. You can probably see some of it here. We're kind of looking the wrong way, but all the cranes around the city. And what's amazing is most of that office construction is already spoken for. It's already leased. So likely to turn into big jobs when those lessees fill that space. And then we look at what's happening with the population, the demographic trends, in-migration trends. What are the current fundamentals? Vacancy, rent growth, the supply side. So we're doing that in a lot of different markets, and then we also balance that with, okay, well, yeah, I love it. Love Seattle. Let's do it. And then you find out, oh, to buy that building that you like with it, everybody else likes it too. And it's so you're competing against a lot of qualified buyers, and the prices get bid up, and the returns are lower. And so you get into markets like Seattle, the initial returns are really low compared to what we have been accustomed to achieving. So that's Opportunity Fund 3, and then that's our target, a little bit about our target market strategy. We have 2 new channels of acquisitions that we're pursuing, and we think we're going to have new equity sources that will partner with us to pursue these. And one is a Core Plus and a Core. Now I mentioned, this is where the lines get blurred a little bit. We have Core Plus, arguably Core Plus type assets in our portfolio now, and we'll continue to do those. But if we're trying to buy a Core Plus asset, say here in Seattle, it might look like a 5-year-old mid-rise building that has 250 units that might be, $75, $80 million. And it might trade at a 4 cap. And we haven't been buyers of, we haven't accepted those low yields going in, but we haven't been able to buy in markets like Seattle. There's equity sources, private equity groups that would look at us and will look at us as a very attractive partner. And so we're going to go seek those out, and we're going to align with the groups that fit with us the best, and we're going to go buy these. And we just were fortunate to get Scott Gilson on board, CJ's brother, who was having a lot of success at JLL on the debt side, and he's very versed in transactions, and he's going to lead this channel for us working with Rob, and he's getting busy with that right now. And in addition to that, we're going to be pursuing core assets. So that's that, luxury high rise. And with these 2 channels, the deal size will be bigger, generally more like the 100 million range. And the groups that would be interested in partnering with us, usually they like the larger transactions. They're trying to place equity of $35, $40 million at a time or higher, 50 million. So Scott just started a month ago with us, and he's busy getting into the different markets that we've identified as target markets and getting his feet on the ground. He's getting networked with brokers, and we're also meeting with potential equity partners. And hopefully we get something done this year, maybe a couple deals done this year. And if you get 2 of those deals done, it's $150, $200 million of acquisitions, so it's very meaningful. And really the sky's the limit for that channel. Once we get it going, it might be 100 to 200 million this year. 200 to 400 million next year, and then it's not unreasonable to think that we could be doing $500 million of those kinds of acquisitions inside of 3 or 4 years. So, you know, with all of these plans, we're a very, very late cycle, right? And we're not trying to be market timers per se. We've got strategies that should work over time, across the economic cycles. But we will hit a correction at some point, and that will tend to slow some of these things down for the duration of whatever that correction is. So the third channel that we're developing is the development channel that we talked about earlier, and we've been getting going on this over the last year or two, and we've been, I would say, walking before we run. We redeveloped the 446 in Pullman was at 35, 40 beds. So
34.
how many?
34.
34 beds. And then we're doing another site that's a little bigger, C Street, also in the Pullman portfolio. And we have the Flats in Eugene, which is 80 units, 228 beds, that's being delivered this year. And so this is I would call that phase one. Right now we've got, 40 million under construction. And Graydon has secured, we have 2 sites that we have under contract and we're pursuing pre-development work on. One is in Eugene. We call it the Good Pasture Project. It's next to Forest Hills. It's 177 units. And that would start construction in January of 2021. And then Greg just secured a site in Reno, near Phoenix, Reno. And Reno! Woo! Rob's favorite place. And that's 175 units, and we're endeavoring to design something that would be really cool workforce housing. And then we're actively bidding on sites in Seattle right now. And we're real intrigued with one that could be a 100-unit apartment deal near University Village, which is a really cool outdoor mall, and near University of Washington. And so that would, yeah. So the Good Pasture deal, it's not fully green lighted, but it's very probable. Redfield, we're doing due diligence on, and then hopefully we secure something in Seattle, assuming we do those 3. I call that phase 2 of our development cycle. And we really have a desire to build this development channel up where it's really kind of equivalent to in activity to what we're doing on the acquisition side. It's just going to be an evolution to get there and really build it up and grow in a smart way. So that 40 million that we have going this year could look like 70 or 80 million next year, and then logically double that year following to where we're getting up to 200, 300, 400 million in development. And it really helps us as a company, as an investment company. It allows us to play along the risk spectrum. I talked about core plus, value add, and then you get to opportunistic. Well, development really belongs over here in the opportunistic because it's much riskier, but if you're successful, you're going to garner higher returns. And so it makes you a much broader, robust investment company if you can be effective all along the risk spectrum. The other thing it does for us is when we're trying to buy, say, Stonehill in North Austin, I think we're somewhere around 150 a unit is our 158 a unit. Well, if we were building in Texas right now, we would be able to say, okay, we can buy Stonehill at 158 a unit, and it's at a 5.5 cap. It's brand new, it looks great, and here's what that looks like. Or we could build, and if we're successful, we can build it for 130 a unit and maybe 7 cap on costs. And that comparison will change over time. And so you can go, oh, hey, we should be allocating a lot more resources towards development just because it's a much better return right now. It's a much better risk-adjusted return. Or, you know what, development doesn't look so good. Huh? Wrap it up?
Start playing music.
Wow.
You got going, man.
Man. Okay, I think I am about done, but let me wrap it up this way. So you add it all up, and this year we may acquire around $300 million, depending on how fast Scott can get off the ground with his new acquisition channels, and we're developing around 40 million. Next year, that could look like 350 to 400 million in acquisitions, and maybe 70 million in development. And by year three to four, we should be at a clip where we're doing $500 million in acquisitions each year and several hundred million in development. And so what does that mean? It means we're going to grow faster than we have historically. And we're not going to be able to do it unless we have you people continuing your growth. As you can see, if you've been around, we've had most success with promoting people. I think Lauren's probably the best example of that. He started out as a file boy, and now he's our COO. And we've had way more success promoting from within than we have going through recruiters and bringing people in, particularly the higher the level of the position, the more difficult it is to get them to fit. And so,
Go ahead and go.
except for Lindsay, she's perfect fit. So we need you, and we need all your talents and energies. I think it's really exciting. It's exciting for us, but it's also going to come with tremendous growth opportunities for everybody in this room, should you want to pursue it.
Woo!
Yeah.
Right.